Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll focus on the news about finance company MFS Pacific. Late on Friday, it told the stock exchange that it had failed to make the interest payments due last week because its parent MFS Ltd had withdrawn support. This is disastrous news for more than 12,000 investors who have at least $291 million tied up in MFS Pacific. That's because MFS Pacific had promised until now that it was backed by listed Australian group MFS Ltd, and that made it safer than many other New Zealand finance companies. It's also a major problem for many investors with the MFS-owned Vestar group of financial advisors. That includes those with the former Northplan and Swains groups. You might recall that Vestar, or MFS, had promised to top up the capital of those investors who had lost money with Bridgecorp and other finance companies that Vestar advisors had put them into. That rescue package must now look unlikely. MFS Pacific has also withdrawn its prospectus and entered into discussions with its trustee, Perpetual Trust, about its future. It has said the put option with MFS remains in place and that MFS Pacific had not been put into receivership. How long that lasts is anyone's guess. MFS also said MFS Ltd had not withdrawn financial support from its other New Zealand businesses, including Vestar and debenture finance company MFS Boston. Market confidence in MFS Ltd, the Australian company, was shaken badly last month after it announced it wanted to raise $550 million in fresh capital by selling shares in Stella, its travel arm. It also disclosed it had a $150 million short-term debt facility that had to be refinanced in March. Meanwhile, the Sunday Star Times has revealed that 14% of MFS Pacific's loan book had got bad by the end of September, and that MFS Pacific bought $22 million of loans from its parent, MFS Ltd, and that some of those had already gone bad. It also revealed that MFS Pacific sent its accounts to the company's office on January 3rd and had refused to release the accounts until February the 1st. Meanwhile, it had continued to take money from the public, and the Companies Office and Securities Commission had continued to let them take money from the public. We'll be watching the fallout from this one, which brings the grand total of debentures and collapsed finance companies to $1.87 billion. And our measures at interest.co.nz show that just over $700 million of that money has already been lost. All for the sake of an extra 2 to 3 percentage points above bank interest rates. Essentially, investors put nearly $2 billion at risk for the sake of an extra $40 to $60 million in interest. Instead, they've lost $700 million. It again reiterates that investors should expect much higher returns from the riskier finance companies and must demand that their financial advisors do much more research. I'm Bernard Hickey from interest.co.nz with the Daily Briefing.